Hello everyone, it's Apex Trades here. Firstly, Merry Christmas and a Happy New Year. Um, let's get this year started off in the right way. I know it's been a kind of a crap 2022, in all honesty. Probably not too dissimilar to 2023 really, based on the economic news. But as you know, as traders, we make money both ways, so it's not always a bad thing when you know what you're doing. So um, why have I been a little bit shy on YouTube lately? Well, if you didn't already know, we've set our own server, Discord server, called Apex Trades, where we educate, we go through lots of different stuff. We have a number of amazingly talented people within the server, and it's all about education and community. So if you want to join along, I'll put the link in the description. If not, I'll maybe someone if you're watching who has a link to the server can add that on. But anyway, I just thought we'd start by looking at BTC. We have to always start with BTC. It's the daddy, let's be honest. And realistically, this is a process that I go through every single time. Doesn't matter what chart I'm looking at. That chart could be BTC, could be ETH, could be Matic, could be gold, could be any forex, you know, anything, indices. I apply the same rationale on every single chart because when you're looking at a chart, when you first open up a chart, it's it's naked, let's just say, and I think you need a framework which essentially gives you the idea where price can move and gravitate towards. So we're going to cover a little bit of that. I've also got Bookmap running in the background, so we're going to have a little look at Confluence, because of course, Confluence is always the most important thing. It's like, you can have an idea in charting and TA, but if it doesn't come together, then your plan is no good. So what are you always trying to find? You're always trying to find um, multiple points that all come together to kind of congregate in one idea, so that the more points, the more touch points you get at these kind of key levels, the better the chance or the higher the probability of you to get your order filled. Now, what we always do, and the way I only exclusively trade, if I'm completely honest, is counter trend. There's probably going to be a bit more of a longer introduction before we dive into it. But counter trend trade, which means I'm not trading with the trend. I'm waiting for a reversal, and there's many reasons behind that. I mean, if you take how the markets like to move, well, market makers like to hunt down liquidity. Why do they like to find liquidity? Well, when you're talking, who is a market maker? A market maker is ultimately those with high capital whose orders are big enough to move the markets. And it takes a lot of capital to move the markets from the price, and they're normally aggressive orders as market orders. So if I'm a market maker and I want to get out of a trade, or I want to get into a trade and I need a huge amount of capital, well, if I'm trading in an area where there's low liquidity, the slippage, the spread between the bid and ask is going to go really crazily, and if I'm trying to get a good entry level or a good exit level, if I'm moving big amounts of capital, and I can't do that efficiently. So, but I can do that in big areas of liquidity. So where, there's a lot of liquidity to be able to, as a market maker, to move big amounts of capital in that area is going to be more beneficial to me. So you're always trying to you're always trying to go from one pool of liquidity to the next area of liquidity. That's where liquidation events come in. That's where huge amount of consolidation come into play. So all about what we want to do is to catch those areas before they return back to some sort of mean area. So without further ado, let's dive in. Now look, this is the BTC chart on the 4-hour. I'm really only interested in this area here. Why? Well, it's where the price action is. We don't need to start thinking about these areas right up here at your 54, 60 odd Ks. It's just fruitless. So the TA will essentially resound around this area, right? So let's kick that straight off. We're going to zoom in just into this area here, and it's where we had the FTX fallout, and then we had some, pretty much consolidation of this area. So before I do anything on a chart, the first thing I'm always going to do is map out my key high term levels, and they are monthlies, they are weeklies, and they are dailies. Okay, now we don't need to go crazy. We only really need to focus on the area of concern right here. So, you can almost just draw a box around the area that you want to focus on. You may go a little bit outside of that, but ultimately we're just going to focus on this area here. Okay, so let's just take that back a little bit. You can almost do that. So let's just start with some monthly levels, right? So to do that, we want to select monthly, nice and easy. And then we just look at the areas of concern and we just map out on the chart. So let me just delete that. We want the magnet tool to be on because it's really critical we actually get the key level. Okay, so you're looking at areas where we've changed, so change the idea of direction. So that's a monthly key time frame. So you can see as prices come down, this candle, I know it's a monthly, and we're only in a few days of that month, but it started off positively. So right now, just marking that off. If that goes down and changes, then we'd remove that as a monthly. It's the only really one that I'm interested in at this level. So we're going to go down to the weekly, and we're going to map out some weekly key term timeframes. So where do we get a directional change? Well, we get one here. I'm just going to template that as my weekly. We get a directional change. Where's this? Move that along. We get a directional change here. I'm going to map that one out as a weekly. And then we get another directional change here. Will be another weekly. Okay. And then we get another one here. It's really, really, really important that you have the magnet tool on when you're doing this, because you want to be absolutely spot on in terms of where that price falls, because you'll see just how close these price kind of magnetizes towards these. So that'll be it for the weekly. I'll just make that one a template again as a weekly, and now we want to move to our daily. Okay, so same again, we're just mapping out. Now this is a monthly, but it's also a daily. You can see we had a reversal here, which is now come to the upside, so that would be a really, really strong area in that sense, but we will just map it out. Okay, again, we're going to template that as a daily, so we have a monthly and a daily level right at that level there. Okay, same can be said, well, it's just a bit above, but you'd put your daily there, template daily. Right here, you can see I'd have another one, but that is also a key daily level, so I'm not going to map that one out there because we've already got it mapped out here. And you can already see how much of an important resistance line this is. You've had a number of days where the body close of the candle has just came at this level, so clearly a significant level of 16,549. Okay, let's do this one here. And you don't have to go too crazy with these because obviously you're gonna it gets a little bit too messy. We could have a daily level there, but obviously it's gonna make the chart get really close. Realistically, you'd say, well, which one's the more important? Well, the more important is the more recent, so this one would be more significant than that one, but we'll just leave it in for now as we don't know if we want to keep it there just yet. Okay, next one. Let's just see, we've got a directional change here. It's a nice daily level there. What, these are getting up to your 1682, so that's a good enough area, still within range of where we can expect BTC to come. Got one here, and as I say, it doesn't really matter what chart you're on. These are always key takeaways in order just to be able to map a framework for where price can be expected to kind of go to, right? So that's another key level we'll just have there. That's a daily. We're just going to do a few more because we don't want to go too nuts, but that one I'll do there. and I think that one will probably do us, but just for good measure, just because it's a little bit higher, I'm going to map that one as well. And where would this one put us? Right at the same key daily level there. Right, okay, we can get rid of that now. Perfect. And we can tidy this up a little bit. So I'm just gonna highlight all of my horizontal rays, right click, and I'm gonna add them into a new group. I'm gonna call this high level time frames. Okay, nice and easy. Just get that there. Okay, perfect. Right, so now we can just to show you the power of this, right, we can go into, let's say, the 1 hour, right? Now it does look a little bit messy when you look at this, but when you actually zoom out, you see how powerful these key levels are. So you can see, for example, we have a move to the downside here. This is probably a key daily level, by the way. I'm just gonna look. I mean, look at that as an example. This hit it right onto the almost to the dollar. So we had this move down, broke through one key daily level, broke through the weekly level, but actually returned right at this point here, which is right on a level. Now you'd say, well, when did this level form? Well, the key daily level formed way back here on like November the 28th, but it came down to the dollar pretty much and then returned back. So the way we like to trade is to DCA. We like to counter trade, remember, so we're always going to be looking for favorable entries that allow us to snag a move to the opposite side. And you can see again just the respect in which these levels have. You can see right here, key daily level was formed. We bounce off it, come to the upside. We didn't map out levels above here, so we don't know at this stage whether these have respected daily levels. But I'm probably going to suggest there'd be a key daily level somewhere around here, just because we've got wicks there, some consolidation, and obviously consolidation around there. But you can see each time, just respecting body closes just on the weekly level, wicks it here. When you do break through, you'll notice you get a really strong move. Again, wicks to this daily level, consolidates around here, pushes back to the upside, has a little break, retests the weekly, shoots back to the upside. These levels are just, it's almost like a guide and a map. So you almost think to yourself, okay, well, right now we are congregating around these levels. So where would we look to expect, price to move back to, with fast active moves? So you could get a move to this side here, because there's no liquidity in between these moves. The liquidity are usually around these areas. So as a market maker, they're going to want to push price to where the liquidity is. So that's why you see these big moves that push through key levels and then revert back to the mean. So we've got our levels mapped out. We're just going to kind of move on a second. So let's just let's see, get rid of them, and we'll just mute them out of the system. So back to the 4 hour. So as well as your key levels, you're also looking for where price becomes, I like to say, sticky. But it's oftentimes where most volume is traded, and you can almost consider that your high term timeframes provide that anyway. But this provides an extra layer of I guess closeness. So what are we? What are they? How do we put them in, and what's the importance? So let's just start off with what I like to add is the visible range volume profile. Now I often get asked the question, what time frame do you use this on? Well, it's whatever time frame you're looking at. If I put the volume weighted average, the visible range volume profile on this entire area, then it's going to provide all the volume where the most volume is traded as an average across all of these. Now, I'm not really interested with how much volume is traded at these levels right now, because this is where the price is. So really, it's like, okay, take an area what's in and around where price action is now to figure out where the most traded volume is. So really, it's you want to. This would be the area, wouldn't it? Right. So I'm just going to zoom in. I'm just going to zoom into the area. This, you don't really need the blow down. You just want this area. This is your visible range, okay? This is the point that is important. It's the point that you're trading within this range. So if I ever say it's the local range, it means the range between where we've been kind of, trading since the past whatever. Okay, so let's add that onto the chart. So it's called the visible range volume profile. It's a stock standard indicator that's provided by TradingView. It's not a community-based one, so you just go and add that on. Now the first thing you'll notice is these bars, these blue bars and this red bar, or the lines rather. They are what's called the high value areas. So it takes essentially 70% of where the volume is traded, maps it out on a chart, and then you have what's called the value area high, the value area low of a 70% range, followed by the point of control. So first thing I like to do again is to just map these out. You can get rid of your magnet because that'll just cause a bit of problem, but we just map that out. I like that to be blue, and this is going to be my value area high. We'll leave it at blue. We leave the color to be blue. We'll click. Actually, we'll create a template. Actually, we won't. It's too pointless. Okay, let's just copy that. We want to bring this to the bottom. We're going to call this the value area low. And if you looked already, I mean, you can see this point here just respected it to the absolute button. And then the point of control. What is the point of control? The most traded volume, of course, of the whole session, or the whole visible range, which you can just see consolidation all around this area, consolidation here, consolidation here and here and here, and it's almost like a magnet. It's where price just goes, ranges between value area high, point of control, value area low. It's just the way it works, just because it's always based around psychology anyway, isn't it? Really, you're just looking at where the trade volume is. Now you just see there, as I've moved my chart, the value areas change, and that's because it's the visible range, right? It's whatever you're seeing within that visible range. Okay, now we just need to add one last line in, and this will be the point of control, and we'll make this red so it stands out nicely. Make this red like that. Style, make it this really bright red. Coordinates, that's fine. Click OK. Now the next thing we want to do is to map out the really the sticky points of the chart again, right? So I'm focusing now on these spikes. Anywhere I see a spike is going to get a horizontal line, okay? Now we'll start here, and we'll color these. I always like to color them like a kind of a maroony color, and just make them, because you don't want them to be too in your face, just a little bit less prevalent, I guess is the word. Yes, that will do. And then now we're just mapping these out on the points there. Okay, keep going. You have to keep doing this, unfortunately, because charts don't stop, do they? They're always on the move. So you want to always make sure you're updating your visible range, understanding where you're trading, and keep these in play. Because you'll see the power of. It's not. I guess it's not so much the previous action. It's what comes. It's trying to anticipate where price is going to go, and realistically, you're going to get these areas are going to be where you. I call it stickiness, but it's exactly right. It's where price action just literally gets stuck to. So got a kind of a busy area around here, so we're just going to map these out. This one. And then, where are we? Just this last one. Hey, Moonrise. If anyone didn't know, Moonrise is one of the mods in the server and an absolute beast. Really solid TA person, understands a lot about how things are moving and the whole kind of stuff that we teach. Huge shout out to Moonrise. Right, so we're just going to create this group now, and these are going to be called VRVP. Now look, all of this, it looks a bit messy, right? And that's fine, but you don't need them always on the chart. You can just take them off. Now we're going to get rid of this indicator. We don't need it. But like I always say, hi Roxas, another one of my cool mods who's just dipped in. But look, what I always say is when you zoomed out into like 4-hour and dailies and stuff like that, it doesn't really make too much sense. But when you go into like the really smaller time frames, like your 15-minute, you really see the power of these VRVP lines and your key level high term time frame. So if we just put them on as an example, again, just to remind people, you see this kind of push to the upside. We wick through a weekly level, we come back down. When we consolidate around here. I mean, this move to the downside illustrates just the power, as I said before, of putting these key time. Now, by the way, not every single one of them are going to be as strong as the next one, but ultimately it doesn't matter. Depending on how you trade is always going to be having a plan and preparing for where price is going to go to. Like as the prices, if you can imagine when the price was say here, a little tip as well to just lock these in place with the little lock. It means that you're not going to accidentally move a line. But one of the things is, when price was dancing around and going from level to level, from this daily to the weekly and back down, and then had a little bit of a slip and come back up, it's like, where's the price going to come to? So you imagine when the price is like here, and you're kind of watching it play out. You are like, okay, well, as the price starts to come faster and moving its way down, it's like there's nothing down here. But if you've mapped out your key levels, which go back further, you just picked up a long to the nearest dollar, which is exactly what it's about. It's about counter trend trading, so that you let me just make sure I get this. Do you want to exit? Yeah. So it's always very important. So let's just take these off. Now we look at the VRVPs. Now what you're looking for is, do we consolidate around these specific areas? We said before, 70% of the chart, value area low, bang, right at the button again. Also where a key daily time frame was. Now remember, this is the low part of a 70% of that visible range, what we showed a little bit earlier. But what you see is, stickiness in the chart. Look right on the point of control, always around here. Ranging between these areas. You're looking at this level. Would you get a short entry here? Absolutely. Why not? Does that provide any further confluence? Well, we just missed the key daily level here, but we would have got filled on a VRVP if you were counter trend trading, and that would have been another significant move, by the way, because when that gets tagged, yeah, it doesn't come back up above that. It just literally starts to come down, bounces off this weekly level, goes up, hits this key level here, goes through a couple of volume profile areas, back up, back down. It's almost like you've got a future framework to work to every single time you put these in. So these are not lagging in any way. These are more for just identifying where price is going to go to. So fantastic tool. Now I go over this a lot in the server, and everyone who's here, if you're from just the server, this will be quite boring, and you've seen all of this, so that's cool. But if you're new to this YouTube channel and you're just understanding a little bit about why and how we tend to be really successful in in our trades, it's because we understand where prices is got a higher probability of going to. Okay, so now we're going to move on to something a little bit more sexy, I think. I want to look at so we just a lot of what I do is looking at things like Elliott wave theory and ABC corrections and stuff like that. But there's obviously this idea around this smart money, which is to say, you know, you are watching price get rejected from certain areas, but it's ultimately why. Why is that always the case? You always have to think about how the market maker likes to move. Like I said earlier on, market makers are people that have significant amounts of capital. Now, I realized this when I was trading at them, right, on Bybit. When you trade with serious amounts of capital, big amounts of capital, much more than what the average retailer will have, there's no liquidity, right? Now, what does that mean when there's no liquidity? It means if I'm a big player in the game, a whale, right, and I'm trading Atom, which is much less liquidity than say Bitcoin. If I want to buy into a position, or I want to get out of a position, more importantly, if I want to get out of a position, if I if no one, I'm just going to act as an absorption if I've got a key level that I want to get out at. If I want to do a market order, well then I'm gonna if I want to sell a huge position of Atom, let's just say, well, the amount of liquidity at these different price points is going to be so far up the channel. What I originally think I'm going to sell out for is going to be much higher. I'm going to lose a lot more money than what I want to do for a market order. And a limit order, if the capital's too significant, it's just going to act as an absorption. So what you'll see is price will come up as market orders aggressively hitting that level, but they're not. But I've got too much capital to sell to get out, so then the price just reverts and goes back down. It means I haven't been able to sell my capital as a whale. So think about it like this: why do you think markets try to move money to where there's liquidity? Because if I'm a market maker, I want to be able to trade where there's a lot of liquidity at these kind of points where markets get sticky. So you'll often see, once the market maker wants to make some money, it'll push the price up really aggressively to an area where there's a lot of liquidity, so we can get back out of that position and then come back down. You see it all the time, this kind of movement of just going up to one level, coming back down, going up to one level, coming back up. Reckon a few people, liquidation points are the favorites because there's a huge amount of liquidity. They can do an awful lot of dumping at these areas, or buying up at these areas, accumulation, distribution. A lot of it's kind of it's always where there's liquidity. So if you hear this kind of term, it's about like, I want to stop hunt, or liquidity grab. It's to go and be able to get out of a big position, or buy into a big position at a certain level. It's exactly what liquidity grabs are effectively. So it's just that mentality of understanding why you'll see a price just aggressively move one way to the other. Um, so how do we figure out where those key levels are? Well, you've often heard the term order block. Order block is, it's this idea where we think markets will want to move to and from. So a lot of the time, and it's a really good process and a really good habit to get into, is figuring these things out yourself. I mean, right now, I can tell you right now that just without even looking, that this will have been an order block. You can just tell. How? Well, you can see, price came down, wicked, liquidity grab, price push right back to the upside. Right? You can see same again, I mean, just this perfect, order block area, even probably more significant than the previous one. Where else would we say there's an order block? Probably here. It's not difficult. You're just looking at these big areas where you see a huge response from one or the other. I mean, this is like a double order block. So you're looking at these areas as strong value areas where there's a lot of value one way or the other, and a very high percentage that price is going to either come to or go from, based on these kind of high areas of value. So You can see, straight away we wick down at this point and move back up. I'm going to delete these anyway. They're not, there's better, there's, let's say, an automated way of having these be reviewed. So what I'm going to show you is this really cool indicator by LuxAlgo. Just going to move this off the chart, and you can see pretty much on point. I think they've probably missed one here. I think definitely one here and one there. But what's it show us? Well, it shows us a number of really key ideas, right? So the first thing it shows us is the order block, and this is exactly where I kind of said one would be. It's where you get a significant amount of rejection. We also have another important feature, which is called a fair value gap, which is to say, if you take the wick here and the wick there, the orders in between, it's an imbalance effectively. So what you see is you'll see the average between these 2 points. So kind of like here and the wick there. Let me just zoom into that a little bit for you actually. So it's taken that wick there, which is the one that follows this one, and the wick previous, and the distance in between is really the imbalance in that candle. So what normally always happens is the market likes to come back and claim the average or 50% of that area. So fair value gaps, vector candles, call them what you want, they are ultimately an imbalance in the chart, so that you can well, it's just a question from Moonrise is, how did you find the fair value gap? If you go into the settings, this is a really cool indicator, by the way. Frustratingly, it took all of the good work that I used to have to do kind of manually and figure it out myself. But basically, you can see here, you have order blocks, you have internal, which let's just say lower or smaller inter-time frame order blocks, and then you have your swing ones, which are your more longer term. On LuxAlgo, yeah, and then how do you want to mitigate? So if we wick past the point, so let's say the price comes up here now and wicks past this point here, it would invalidate this order block, and then it would essentially repaint a new order block. So you've got a new kind of idea on where that would go. You see these kind of blue things here, which are called liquidity grabs. They're just where you, as I said before, price comes down, takes some liquidity, and then pushes back to the upside. Usually, this is where big players want to get out of the game, or big players want to push price down to get back better price entry for their movements. But it's just, yeah, it's a fantastic tool. You can see another fair value gap here. Now, what I like about the way LuxAlgo works is if it's still live, it means it hasn't been filled. So these are all fair value gaps. We've got a fair value gap to the downside. The average of that fair value gap would be 15,938. It was never really filled. Now those people in our server who know the trader's reality will also know that these are also, you can think of these as a vector candle. You'll have a big green vector candle here, which is this, fast, high-paced movement where we haven't came back and reclaimed it. It's exactly what a fair value gap is, to be completely honest. And we've still got, we've got fair value gap here, which hasn't really been claimed, although I would say the arguments for this one is not really correct, because this fair value gap was filled by this candle here. That might just be a setting, but this one definitely hasn't been reclaimed, and this one has been reclaimed by this vector, by this return here. So what's likely to play out? Well, it feels like we're on a bit of a pump at the moment, for sure, doesn't it? We've had this kind of move to the downside, and then we had this kind of consolidation, bit of an ABC pattern, could also be a WXY pattern, and then we've had a push to the upside. Then we had, obviously, this was the FTX drama, but this move to the downside here, so we had this kind of creep up, but the move to the downside happened and then came out at this. I mean, this was the previous month high. Didn't quite come up to reclaim this change of character area here. But as prices come back down, we've consolidated again. And now the question is, so this was the FTX drama, wasn't it? So am I just getting myself mistakenly? Let me just double check where we are here. No, this was the FTX. My apologies. Did we claim it? So here's what you want to do always, on the this idea. So we're going to the pivot high of where the FTX was. We're going to go to the low, and we just want to see, significance on the chart. So you could argue here that we've reclaimed, this would be a reclaim of the 50%, right, of the FTX drop. So you could say, okay, well, this is now fair. Not quite. We just missed it by a very small point, but that would still be considered, that would be acceptable in terms of that's now price can start to move back down again. And you've seen exactly what happens. If you take this off the screen, price hit that 50% retracement and then came back down. So now the question is, well, where can we come up to again here now? Well, you do the same again. You take your Fibonacci retracements, you go to the low, and then you're looking at where the 0.5 is. So the 0.5 is usually, it's not always, by the way, but it's usually where you want to retrace back to kind of, let's say, close out the area. The other thing as well is, obviously, you can also have, if I just select this and go, I haven't got it saved on here, but you can have the golden pocket, which is between 0.618 and 65 or 61.8% and 65%. It's kind of about in this area here, just somewhere around there. So that's like the golden pocket area. So realistically, that's where price likes to get back to, but will accept 0.5. So what would that look like for a move to the downside? So we've had, if we consider that this would be, let's say number one of an Elliott wave, right? And we've ran this, TA, plenty of times, but like that would be, move one, and you'd have kind of, I don't know whether you'd say that this would be move two, but within here you've got an A, B, C correction. And now the idea would be within this move here. So now coming down into here, you'd want to see a new Elliott third wave, which should be a much more aggressive kind of move. So if you took the ABC as an example, so we've got 0, 1, 2, you'd want somewhere like 3 to be here, maybe 4, and then, I'm just going to put this here as an example to where we could come back and retrace to. So 2 to 3, this right now is not favorable for where I would be wanting my ABC to move. So if I say, you've got, that could be A. We could have B, could be, say, here. And then usually you'll have a C that kind of, it's a much longer wave, but looking at the way this is kind of playing out, it kind of has that feel to me. So you've got, you move one on Elliott wave, then your retracement phase for phase 2, or your corrective phase. Phase 3 would be down here, but your Elliott wave number 2 could be here with C. Sorry, that's not wrong. The problem with Elliott waves is you've always got to be mindful of the structure, right? Always got to be refining and rechanging and kind of scoping out where things could be. So, when we were looking at this point here, we were thinking, okay, well, this might be A. So you could say, for argument's sake, this could be A, this could be B, and then this could be C. And that would be a valid argument because you've got your 5 waves within your B to C, let's just say. But the problem is, because this, if we count this as wave 1 of a much larger wave, we'd expect to see at this point some sort of a push down. So you have to then say, okay, well, let's restructure the ABC pattern so that it would does it still fit the narrative, or are we trying to fit round pegs in square holes? It's like sometimes Elliott wave theory can get a little bit like that, so you've got to be careful. But you always have to kind of reposition where you think this new idea might be. So again, if this was wave one, wave two maybe here. I mean, you would think that would have been wave two simply because it closed out that 0.5 gap. However, if we think an ABC correction is on the cards, and I'm not being funny, this, right now we could be shaping up for like a bit of a move to the upside, because it's kind of like a bit of a cup and handle formation, which the charts always like to see. And then, the chart comes up here, and then you get your huge move to the downside for wave three. But just to kind of continue this idea, it's like, well, where would wave three potentially go? Well, you would take your low and then your high, and then you would figure out on your point. So we take the extension tool. We'd go from our lowest point here to the highest point there, and then back down to the low. And what you're looking for is so there's the 1-to-1, but you can say, well, 1.271 would be an area. We could have 4.41 or even the 618. I very much doubt it would be as high as that. I'd probably suggest maybe it could be this 271. Why? Well, we could come back, reclaim this fair value gap here, would be another area of confluence where you'd suspect that that's a likely area that it could come back to. Doesn't always have to come right to the 272. Realistically, this point here didn't come right to the 0.5. It came just shy. Well, just shy of that is your average fair value gap here. So if we was to plot that, this could be your C for your eventual ABC correction before a huge move to the downside. Well, where would that put us in terms of timing? Let's say, I don't know. I mean, again, we don't know when this is going to be, but if we do see a push to the upside, let's say something like we could get some good positive news from unemployment rates, CPI data could start going against, could start going for the Fed. It may start to reduce inflation a little bit. Who knows? I mean, I'm just making stuff up on the fly here, but you could get these kind of ideas that is a bullish signal to move the price up. Before a third wave to the downside. Now, a third wave to the downside may not happen. It's just everything's always a theory and probability. But I don't think 2023 is going to be anything of a better year than 2022. We're still at nearly 8. Well, I think we are at 8% inflation in the US. UK is already in a recession. There's lots of reasons to be fearful about the market. So, like I always say, market maker likes to try to push price to one side to get value for that before that move to the downside. Sorry, so that's entirely possible. Everything's just a conjecture, but smaller time frames. You're looking at. So right now we're looking at the 4 hour. I mean, we've got a fair value gap. An order block here. We've got a fair value gap here. These are reasons where price could eventually move to from a longer term move. However, we could just come back to the 0.5 to actually reclaim it, or the golden pocket here, and then come back down again. Anything's possible when it comes to this kind of thing. There's no, it's just a guide at the end of the day. Elliott waves are just guides. There's nothing concrete that says it must follow this, because if you subscribe to that idea, then you are either never going to get filled or you're always going to get wrecked. You've always got to try to be accommodating to how things move in the markets. So let's just get rid of some of this stuff, because I don't want it to convolute stuff. In terms of right now, you could expect price. We've got the previous day high here, so it's a nice area of confluence. So here's where now we take the original TA we done for the dailies and the weeklies and the monthlies, as well as the VRVPs, and we understand if we got any confluence around these areas. Well, on the previous day high between here and here, we've got the point of control, which is just at the bottom of this 4 hour order block. At the top of that, we've got the previous week high. And then we've got the premium. Now the premium, still trying to figure out how they managed to paint these, but you've got the premium here, which is to say, if you was to buy Bitcoin at this price, you'd be paying a premium. If you buy Bitcoin at this price, you'd be buying it at a much discount. But it's like it's just taken, you know, it's painted it when this high of the move from this larger move to the downside as printed, and this will repaint. So I think it's almost like if the price came up to here, let's just say the premium would move up to here. It's almost like the local high. I think still need to figure it out, to be honest with you, but it's an area that seems to be respected, and I don't know if that's more around the fact that it's mass psychology, because there's that many people that use, let's say, the LuxAlgo price concepts. The more people that use it, the more often that price will be respected. Because think about it, if a billion people have got short orders in this premium area here, and we can check that, on this so where's that, this area here is 17055. Let's just dive into Bookmap, right, and see what that area is. So 17055, okay. And this is really how you start to look at confluence. So 17, and right now we're looking at Atom. Let's go to BTC. 17055. Not really. There's not, from a Bookmap perspective, you'd say the bigger area in terms of is 16900. You can see you've got over 681 BTC there at 680. Sorry, 16,800. You've got a lot of liquidity there. All quite similar values, to be honest, somewhere ranging between 500 to 600 BTC orders in and around them, that kind of 16,800 to 17,100 area. Below we've got a similar kind of narrative. So you've got a pretty even order book balanced at the moment, and that's because realistically there's indecision in the markets. We're starting to approach the point of control, remember, on TradingView, which means when you start to get back to that area, you're back to indecision and imbalance again. So as we as we look at TradingView, it comes as no surprise that we are approaching this point of control area again, and we're seeing a balance between the order book. So you've always got to keep that in mind. So I would probably disregard this premium area simply because right now it's not offering anything. However, that's not to say as price moves, remember it's an order book, it's a live painted picture of what's going on currently live within the order book. So you don't know, things can change at the flick of a switch when it comes to order flow. So you need to be able to always keep this in the background and seeing what's going on. So yeah, where does the kind of more longer term look? Well, I can almost guarantee, maybe not guarantee, that's not a good word to use, but high probability is the better word to use, that we are going to come up and at least test the point of control. We've got orders at that area. I think we're also going to maybe come up and maybe test this order block here, and then even can we come up as high as test this fair value gap here. Every possibility. We seem to have seen over the past few days a lot of volatility, which, by the way, in a retail only market, let's just say, because let's say the majority of the world was closed down, New Year's Eve, Christmas, bank holidays. So it was surprised to see how much volume was flowing through the markets. But anyway, so prices is starting to move up. The local high now is this previous day high, and if it breaks that, you can almost certainly guarantee that we're going to come and break this point of control area, which is at that 16,828 and just beneath the order block. So very, very interesting area to see how that moves. Now, here's what's key to understand as well. When we look at different time frames, we see different levels in terms of order blocks. I'm just going to remove this off a quick second. We'll get rid of that. That was just the golden pocket area drew, and we're going to go to the 15-minute. So if we want to trade shorter time frames into intraday, scalp in and a scalp out, this is where this is really powerful again, because it shows you these kind of ideas where, this again is previous day high, interesting area to come to. Equilibrium is the point between the premium and the discount. Just so you know, you can almost think of the premium and this discount as like a volume weighted average price. So where would price be at a discount? Where would it be at the VWAP? And this is the equilibrium area. So where the VWAP would be, volume weighted average price, or the price you paid for your Bitcoin here would be fair value. Yeah, price you pay here, you're getting it at a discount. Price you pay here, you're getting it at a premium. It's just how a VWAP kind of works, and how institutions buy and sell above or below the VWAP. I don't think it needs to be any more complex than that. Although, I'd like for someone to be able to tell me exactly if I'm right or wrong on that. But seems like a fair idea to me. um. So yeah, just using this as a level to level kind of idea. So, again, is where we bring in another concept around oscillators. But again, these are what filter out whether it's advisable to get into an order or not advisable to get into an order, in terms of, are you coming from a position of strength, or are you coming from a position of weakness? Weakness being massively overbought, and you're buying when it's massively overbought. That's not a really smart idea at all. Right, I am just looking for the money flow index. Okay, so right now, as you can see, I mean, it's printed. Let me just zoom in a little bit here so you can see that. On the 15-minute, it's printed a liquidity grab, push to the upside, grab this liquidity. Now price is moving back down. This is the 15-minute. Yeah, you're seeing, nice, nice confluence between the peak of where the MFI, which is obviously the volume, and the price, almost like your RSI, but it takes volume into account. Hits the top also of the squeeze momentum indicator, and then it comes back down. So we're seeing some nice confluence there. But the idea here is, you can see it strikes the heart line. We have a really weak squeeze. We have a really weak squeeze momentum on the bearish side, and then we push back up again. Now this is a liquidity grab, but you can see hits the equilibrium part to the dollar, and is the room to move to the upside. So you always got to be careful, but you think, oh, liquidity grab, this might mean that this is now an area where it won't get past, because there was a lot of buying power that came, sorry, a lot of selling power that came into this. However, I'd probably say be careful, because we've still got momentum. We're only on the 15-minute. But how would you trade this? Again, you're just hitting your buys, you're hitting your sells, hitting your buys, hitting your sells. If it goes to the next level, okay, this is DCA2, possibly. It's not just that. We need to identify confluence, but it doesn't have to be complex, and you can get snipe in and snipe out quite easily. Just day trading this you're swinging, your much higher time frames. So it's still in test phase for me at the moment, but I really like what I'm looking at. I like that the order blocks automate. I like that they become invalidated once they get breached. I think that's a really powerful thing. And as a trader, you just want to switch your chart on, look at where the key areas of value are, and just trade. That's really it. You don't want to have too much by way of noise. But having said that, that can also be a good thing as well, where you have to keep forcing yourself, because you don't want to be lazy. That's why it's always important to make sure you are managing, your areas of understanding your oscillators, knowing when we're overbought and oversold, knowing where your key levels are, because one thing that the algo won't give you is your key levels. So, I would suggest, as an example, right? Okay, we've got an order block here, but if price swings past that order block, where can it go to? Well, it's not going to tell us that, is it? Maybe it does on a higher time frame, but I'd be much more confident at looking at your point of control. You've got a weekly and a daily, all at that area for a possible rejection point. Maybe I'd even go to this level, this level, this level, and so on and so forth. So I think it's about combining your own studiousness as a TA analyst with some of the automation of the smart money concept. So combining, proper TA, proper risk management, understanding how you manage levels, and I don't think it needs to be much more difficult than that. But yeah, so I think that's probably it for this TA session. Covered a lot actually, but we are approaching 55 minutes, and trying to not keep these too long. Um, I'm just going to put up the promo next of our Discord server. I do believe it has a link on there. By the way, guys, if anyone in the YouTube comments would mind just pasting the server link, I would really, really appreciate that, just because I don't think I've got it currently on this in the description. So if anyone's got that, that would be fantastic. In the meantime, I'm just going to share a nice little promo video for the server. Feel free to jump on board. We teach this stuff all day long, and everyone's kind of really enjoys the community kind of vibe and whatnot. So that being said, I'll leave you guys in peace, and we shall talk later. Thank you very much, and see you soon.